Okay, so let me get everything set up here. And I apologize if I sound bad. I have a cold, but I'm hanging in there as best as possible. Okay, so let me do the slideshow, play from the start. Alrighty. All right, guys. So we're doing a course tonight or a presentation on budgeting in particular. So that word comes up often and people start to freak out. They think it might be restrictive or something they have to, add to the already complicated life they got going on. So understand that a budget is a good thing. And so we're trying to rewire our brains to understand this is actually going to help us. It's just a tool like anything else, like our money. And if we learn how to use it correctly, we're able to do really good things with our money as well. So let's get started. All right, so I'm going to start off with a quote. The budget is not just a collection of numbers, but an expression of our values and aspirations. The reason I picked this quote in particular is because oftentimes people are afraid to start budgeting for whatever reason. And a lot of times it's because the truth comes out. So if you're looking at your expenses and you're like, I spent X amount on going out to eat. Well, I'm trying to eat healthy, but that's telling me I'm not eating healthy type thing. People are discouraged by that stuff. So it's really nothing to be discouraged about, but oftentimes people feel that way. And so therefore it kind of prevents them from starting, which is a deterrent. So this is what a budget's going to provide you. So when you think of basic budgeting, right, you're going to have control over your money. You're going to have a detailed written plan. A detailed written plan is critical because a lot of times we think about this stuff in our head, and we say, we spend, let's say, our mortgage or rent is $1,000. We know we have a car payment or something like that.
Can you
There's
share your
basic
screen for
things.
us, please?
I'm sorry, what?
Can you share your screen for us, please?
Oh, I'm so sorry. I thought I was sharing my screen. All right, here we go. Apologize about that, guys. So anyways, you didn't miss much yet. So detailed written plan is what I was talking about. And with this, a lot of people will get on these plans and they'll think about it, but they won't actually write it down. And so when push comes to shove and life happens, it's really hard to do that in your head. And it becomes a huge challenge. So that's what a budget's going to provide you. And lastly, clarity, peace, and lower blood pressure. And I joke about the lower blood pressure, but I'm dead serious, especially being a type A person myself. It is extremely helpful to have something on paper. So when life happens, you can kind of look back on it and see, although I was knocked off course, I can get back on and, get to what I'm trying to accomplish here. All right. So for those of you guys that don't follow me on Instagram or Twitter, this is a really good template. I have a free budget template for you guys that you guys can actually download. So it's in my link in bio. It's going to look like this when you click on my link in bio, either my Twitter, my Facebook, or my Instagram. Here's my right here, Budgetdog. And it would be the free budget template. Go ahead and download that. As you guys get through your budget, this is a really helpful tool because it's going to have built-in analysis for you. And it's just something very simple. It's already built for you. You just have to start inputting numbers. So it's a great tool. I highly recommend it. And of course, it's free. So can't beat that. All right. So the 5 areas to consider in your budget. So let's get into the detail here. Very first thing is fixed income. So when you think of, hey, how much am I going to have coming in for the month of January? Let's say we were just in January 2021. All right, so we have a salary or we have an hourly wage. We're paid out weekly, bi-weekly, bi-monthly, whatever it may be. This is exactly what you're going to be looking at as a fixed income. It sounds simple, but a lot of people just leave this where they don't really fully account for these kind of things. Variable income, commissions, bonuses, one-time payments at work for something you didn't, maybe OT or something like that. Variable income is a huge piece of the equation because oftentimes they come in on an unscheduled basis. They're not part of the monthly budget. Stuff like a 1-year, Christmas bonus. it just kind of comes in at the end. So to be able to really account for that in the right way is really important. And then you have your fixed expenses, um, mortgage, car, utilities. And I say utilities, we'll get into that a little more in just a second. But these are important because we have to know everything we are automatically going to be paying. I always talk about automating these expenses. These are the ones that you just know they're automatic withdrawals if you want them to be. So definitely understand these ones. Then we get into variable expenses. And this is where people lose in their budget almost every single time is not understanding all of these items. They're kind of just, they're not really consistent, but they're consistent enough. They pop up here and there. So like groceries, obviously we're going to get groceries, but we just don't know what that expense is going to be. It could be 300 bucks a month, or it could be $800 a month, but that variance or that difference is going to be really big when it comes to budgeting and planning everything out. And then lastly, clothing here, stuff like that would be, you need a new suit for work, or you need a new polo, whatever, uniform at work. And these things will bust your budget really fast because those things can be expensive, but they're one off and you don't think about it. And that's where people get themselves in credit card debt. And then lastly is the actual one-time events, such as vacations, a new car, a wedding. And oftentimes we know these things are coming, but we don't know exactly how much it would be or exactly the date. But to be able to plan for this, I'll talk about strategies around this here soon, is really important when it comes to budgeting. So let's get into the next slide. So zero-based budgeting is very, very big. When it comes to budgeting in general, I always recommend anybody to do the zero-based budgeting tool. And essentially what that is before the month actually happens, right? You're going to plan out every single expense. You're going to know where every single dollar goes. And this isn't a very time consuming process, but once you get the hang of it, but at first it is going to be a lot different than normal, right? You're going to have to be used to sitting down with your spouse. Let's say you have a spouse. It's really important to be on the same page and talk through these things with them. So you're going to say, let's say December 31st, you're looking into January 2021, and you're saying, okay, let's start here with the first piece, fixed income. Let's figure out, are we salary? Are we commissioned? Are there going to be bonuses, etc.? The income piece is important, and then we'll get back down to the fixed expenses, variable expenses, and one-time expenses. And so with that, your income minus your expenses, and this could be investing, this will include investing and stuff like that, will be zero. Because the worst thing in the world to happen is for you to have, let's say, $5,000 in total income, and you get down here at 4,000 expenses, and you have 1,000 left over, but you don't have a plan for where that money goes. It typically goes to spend or things that we're not budgeting for, right? Things that we weren't really expecting. So zero-based budgeting, I think, is the best method to do this. It's just basically planning out and mapping out the month ahead of time. And your actuals are going to come in, and there's going to be a little bit of difference slightly. But if you do this for a couple months, let's say 3 months, you're going to start to get pretty good at this process. It's going to be very easy to map out the month ahead of you. And I don't think you guys are going to see many problems. So let's go into a variable income example. So if you watched my last presentation, I like to use Denise and Oscar as my co-host right now. So let's put these two people into the same situation. So they both make $50,000 per year. Denise earns a year-end bonus, but Oscar earns a monthly commission. So how are they going to actually go about budgeting when it comes to variable income? This is important because a lot of people look at these differently, but this is probably the best way to do it to be safe. So in Denise's situation, she has a salary of 40,000 and a bonus of 10,000. So the bonus is going to come at year end. So throughout the year, she can't really account for that bonus from month to month. She's not going to get it until, let's say, December. So her expenses are not going to be covered by that bonus. And so she's going to use $40,000 as her budgeted income throughout the year. And then when that bonus hits at year end, she's going to have a plan saying, whatever step I'm on currently, she's going to allocate that bonus to, whether that be paying off debt, saving for an emergency fund, investing, college education for children, whatever it may be. She's going to use that bonus to take care of that. Whereas you have Oscar's situation, he has the same salary of 40,000, but he has a monthly commission of 10,000. So it's pretty consistent. It's obviously dependent on how many sales he makes for that month, but he has a pretty good idea of, it's probably a 800, 700, $800 a month, and he has a pretty good feel of it. So he's going to include that in his budget income for the month. And it's going to be 50,000 instead throughout the whole year, whereas Denise is 40,000. So I hope that kind of makes sense going forward, because I know a lot of people have commission-based jobs, also bonuses, and I always treat those two different things, two different items. Okay, so fixed expenses. So we're going to look at this budget in total. So we're going to focus on this gray shaded area for this fixed expenses, and we'll get down here as we go throughout the examples. So your fixed expenses, I'm going to tell you straight up, as I said earlier, automate everything you guys can. So if you look at these expenses, let's walk through these. Mortgage, homeowners insurance, phone, automobile insurance, gym, and et cetera. And you can look down this list. I did include retirement investing and non-retirement investing here because this should be something that you automate every single month. There is no maybe, maybe not. This is something that should be part of your budget. So you should include it. Whereas Rumpke here, for those of you guys don't know that, that's just trash. So if you own a home, you have to pay that trash fee. And then we get down here, which is water and Duke gas. So I actually used my personal example of Duke gas. This is just our utilities. So when it comes to utilities, as I have a variance here, you see we have the actual, this is what we planned for in the budget column, and then the actual, it came through, and there was slightly a difference, right? Because water, Duke gas, is pretty hard to plan for exactly. So what I typically recommend for this is budget billing or even billing. So a tip that I did when I first moved to my house was I called the utility companies, that was gas, water, electric, all those, because I know they vary depending on where you live. If you live out in Arizona or California, your electric and heating bill could change drastically and very, very high at certain points of the month. So with budget billing, the best thing to do is to do a trailing, or what it is a trailing 12-month average. So it's going to slightly vary, like I showed you in the last slide, of $2 to $3, but it's going to have the last 12 months. So your spikes are going to be very, very minimal, $10 at max. So you can really, really plan out, this is going to be $80 a month to $90 a month every single month. It's obviously going to vary slightly, but that's okay. Even billing is a little different. So what this is the exact same cost per month for 11 months of the year. First 11 months, exactly the same. Month 12, they take the actual spent for the year minus what you've actually paid for the actual year to date. So if, let's say, you come in at $900 and the total bill is $1,000, well, you're going to have to make up that difference of $100. Whereas if you came under, let's say, $800, well, now the utility company is going to refund you $100. So these are really two good ways. I would absolutely call your guys' utility companies. Every one of them offers some sort of budget or even billing at some capacity. All right, so variable expenses. So same example here, but now we're going to look at this gray shaded area down here. Obviously, you can see there's a lot more variance here from the actual to budget. So gas, we budgeted, let's say, $47, and we came in actually under $36.78. So we've actually, we're over or under budget $10. That's a good thing. That's a positive, right? Whereas food, same situation. We planned for 680 and we were down by, we only spent $650. But then you get to clothing and you're like, hey, I was going to go get a polo, but you went to the polo shop and you bought an extra pair of jeans, or you did something extra and you spent $100. Well, in this case, you're over budget. So I'm going to talk about analysis later of how you actually take this data and really truly improve upon it. But this is a really good thing to understand, that these variable expenses are automatically going to be different just based on the nature of the expense. It's impossible to predict to the dollar amount. But at the same time, if you do an analysis of your prior spending, and you're going to get better as time goes on. So these variable expense differences are going to likely get smaller and smaller as you go. And then one-time expenses. So this is things like weddings, new cars, even miscellaneous items that you're just planning for in the future. The best way to do this, so you're going to have as you see here, there's not really any difference for the wedding and car because we should know this. And how do we do that, right? So I'm going to take you into this cool example of a sinking fund. So for those that don't understand what sinking funds are, sinking funds are simply when one sets aside income over a period of time to fund a future expense. So Denise and Oscar are back at it again. So they both want to save for their new car in the future. However, their timeframes are slightly different, but they still want to plan for this. So this is just planning in the future, right? They understand in a certain amount of months, their new car is going to cost them $20,000, but they don't understand. They both have different situations. Denise is going to say, hey, it's in 20 months, so I can save 20,000 divided by 20 months is $1,000 per month. Whereas Oscar, still 20,000, but he needs to buy a lot quicker. So it's 10 months. So it's a lot quicker, and he just divides that by 10, and he has to save 2,000 per month. So if you go back to this slide, as you can see that $1,000 per month is budgeted for because you've planned it out with a sinking fund, and you know exactly what's coming each month. So let's say, 20 months from now, Denise is going to have that $20,000 sitting in a cash fund, ready to purchase that car with cash, because she's planned for it in the future, in the past. Same with Oscar. He's going to know in 10 months, hey, I can pull this cash out of my bank account and go to the dealership and buy that new car because I planned for it and it's been part of my budget for the last 10, 20 months. Obviously, there's a difference between here, but they're still doing the same thing. Okay, so for those that have not budgeted in the past or looking to do this, obviously, like I said, you guys can download my budget template. It's a really good starter tool for anybody to use. But this is what I recommend for most people to do, is to do a 3-month look back analysis. So when it comes to budgeting, you have zero idea, you've never done anything with budgeting, and you don't even know what you spend. You're literally thinking about it right now through your head, and you're like, I actually don't really truly know what I'm spending, and I need to, right? So step by step, how you do this. Download your bank statements for the past 3 months. Just go online, pnc.com, whatever bank you use, and just download those statements. As you get those statements, also download a budget app. So 3 that come to mind are the ones right here. Mint is the one I use personally. You Need a Budget is a really good tool, and then Personal Capital. So these are 3 tools that you can link to your bank for your transactions to automate through here, and you can categorize them and do it virtually if you would like. What I do personally, I took this app and I just categorized them from my bank to one of these budget apps, which is Mint. And then I just went ahead and took that information and imported it into my spreadsheet manually. So I think manually is a better way to do a budget, just because a lot of times if you actually do the budget manually, you think about it more so than when it's all automated. And so, yeah, step 3, link the bank to the budget app, and then start tracking, start looking back, do the budget for the last 3 months. So actually put the pen to paper and figure out, hey, we spent $1,000 in groceries this month. We spent $800 in groceries the second month and $900 the third month. Well, likely you're going to spend around $900 based on the averages. So you would start that as your initial start point is $900. And then you're going to look at that and you're going to say, is $900 doable with our current income? Does it make most sense to do this? Yes or no? And then you're going to adjust accordingly. And then so going forward, you're going to understand, hey, we need to groceries down to $750 so we can invest, $20 more per month, whatever it may be. And you can start to kind of game plan the numbers a lot better, and it becomes fun. A lot of people will crunch these numbers so low, and they'll be able to really save a lot of money just by looking at, wow, I have $1,000. I didn't know where that was going. If we put this to X, Y, and Z, we're gonna make a lot of progress. So that's really, really smart thing to do. So then it gets to the analysis stage, and everyone has a good budget throughout the year, but from time to time, you kind of forget. You kind of take for granted that you're just kind of importing numbers, and sometimes it kind of maybe a month or two goes by and you haven't really paid attention to too much. But something that I think is very important, and my budget template has this right here, is there's an average thing for each expense item category right here. You're going to have a year under your belt because it's going to be a look back analysis from prior year to 2021. So if you have your prior year numbers, once you do a full year of budgeting, you'll have these numbers. You'll just hard code these in, and then your current budget's going to have these numbers right here, and it's going to average, and it's going to take the difference here, and it's going to show you, hey, we spent less on our mortgage. So why did that happen? The phone. Oh, we don't pay for a phone, it looks like, right? Okay, well, that makes sense. Automobile insurance went technically up $1.76. And so I just conditional format these in to show up in green or red or whatever. And as you look at these, you can kind of start to look, I have here notable items of greater than $25. So on an average, if it's greater than $25, that's somewhat substantial, especially for these fixed expenses. And I can explain why this happened, why this increase incurred. So like, for example, the mortgage went down because we refinanced for a longer term, for example. Let's say that, right? And so I put, it went down because of refinanced mortgage. B, right here, we looked at gas. So I used to get a gas reimbursement. So I'd actually have a negative position. I'd basically be refunded so much money. I'd be making money technically. And so this year there's no driving, so no gas refund. So all my gas expenses are currently just at my disposal. So that's where you see that. And this is huge, guys, to really look back at the year and see what increased, what decreased, what changes you're going to make going forward and all that. And then more analysis. So paralysis by the analysis is a bad thing at times, but annually, I think it's a great thing to do, especially when it comes to this. So let's say this is two separate situations. So in this situation, you have your budgeted net salary and your budgeted monthly expenses. And so you can look based on prior year data. Hey, this mortgage is 20% of my budgeted net salary. And you can kind of pinpoint what pieces of this budget are really sticking out, right? And so I highlighted everything over 10% here. So the mortgage 20%. Okay, well, that's reasonable based on, they say take home percent, 25% of your take home. That's reasonable. This is my take home within 25%. I feel pretty good there. And then you kind of look down this line and it looks like, you aren't spending too much money in total. So it must be going elsewhere. Then you look at your expense to total expense and you see, okay, my mortgage is 40% of all my expenses here. That's pretty solid. When you're saying it's only 20% of my take home. You look at food, okay, that's 20%. Let's maybe get this down to 15. And you can start to play with these numbers and get these aligned into what you want. But until you get this budget and this actual data down, it's hard to do that, right? And then over here, I have actuals to the actual numbers that came through. So our actual salary in this situation didn't change much, but this is just an example. So yeah, these are really good tools, guys, to use to game plan and to plan for the future. And then I know everyone's heard this a million times, but the most fundamental financial rule is spend less than you make. So when you have a budget and you first put it to paper, a lot of times you're going to have more income or more expenses than you have income. And that's a scary realization, but it's something that you guys can easily fix because it's once you have it on paper and you know what's causing that negative, that deficit, you can say, okay, I'm spending a lot on clothes or I'm getting a lot of shoes every month. Maybe I need to cut back on pairs of shoes, stuff like that. So that is my presentation. I wanted to make this a little shorter than normal because I want to open it up for questions. I know that you guys, questions are probably more important for something like this. So feel free to shoot them at me. I'm going to see if I can see the chat box. You guys know where I could do that?
You may have to stop sharing your screen to be able to see that.
Oh, gotcha. There we go. Okay. So I'm going to hit the chat. Let's see. So it looks like somebody uses Quicken. That's awesome. That's a good thing. That's what my dad uses actually personally. I use QuickBooks for my business personally. Yeah, guys. So I think the best. Can you also post the budgeting template? Yes, I will post the budgeting template to Wealth Squad. I'll talk with Chris about doing that, and I will make sure. But keep throwing your questions in this box, and I'll go ahead and do that. Every dollar free version. Yes, guys, every dollar is a Dave Ramsey app. I highly recommend that as well. I did not list that in the presentation, but you guys will like that one as well. What do we use to have a fund, a sinking fund? Okay, so when you guys talk about sinking funds, what we need to do for that would be open let's say a checking account. If you have a checking account, it might have like a savings, or I know at PNC Bank, I don't know, everyone uses somebody different, but they'll have like this intermediate account. You can just put it in a cash, maybe a high yield savings account or a checking account, but keep it in cash. You don't want to put it in an investment or anything like that. My emergency fund in particular is in a money market. So that would be the only other option I would give you. But I would just say, as long as it's in cash and you're not trying to make a return on it, just save it wherever that would be for you. Probably a checking account though. Is QuickBooks worth the price? I just got QuickBooks last week. I just started my LLC in my business bank and everything, so I wanted to get QuickBooks. I've heard that's really good. It's only for me, I think $12.99. I think it's extremely worth it so far. I haven't even seen all the functionality yet, but the capabilities I've seen so far are really, really good. I can run a balance sheet. Most of you guys know I'm a CPA, so I like that kind of stuff. To see the P&L statement, like the income statement, that's always good. And all these reports you can run really fast. Before last week, I was manually recording all my income and my expenses, and that was ridiculous because it was actually going to my personal bank, which was out of hand. There was so many transactions because, as you guys know, I sell low volume or low cost products. Like, my book's $20, so like so many of those comes through, and to record all those is a nightmare. So I think QuickBooks is absolutely worth it, especially on the personal level. Where would I be able to get your template? My template is in my link in bio, in any of my social medias, Instagram, Twitter, Facebook. Technically, I don't use Facebook too much, but yeah, it's anywhere there. Link in bio, you'll see it. I'm going to show you guys real fast. I'm going to share my screen one more time. I think in the beginning it was not sharing, so I want to make sure you guys can see this. So first slide, that was the second slide, and the third slide was that. And then this was where you could download the free budget template. So if you guys go to my link in bio, you're going to see something like this. It's this, obviously just this free budget template right there. And that is where you're going to find it. All right, let me get back to.
Sorry, we still couldn't see it.
Oh, I keep doing, I keep forgetting to
Thank
share my screen when I do that. Give me a second. All right, share screen. There we go. I'm using a Mac, so it's been an adjustment. Okay, so you guys can see it now, right?
Yes.
Okay, so when you guys go to my link in bio, you're going to see a page like this. These are just all my links, and this is a free budget template right here. So you will find that the right investment, just FYI, why I have you guys, this is a free tool as well. You can search different investment firms. I think we have 35 at this point on there, and you can kind of compare and contrast. So it's pretty cool. All right. If you go to his Instagram, click, link in bio template there. Can you talk about the 50-30-20 rule in the best circumstances to use this type of budget? Yeah, so the 50-30-20 rule is 50% your expense, 30% your wants, and 20% investing. And so when I think about this, I don't personally use this rule. I think it's a really good starting point for sure, but you're going to understand everyone's budget's so different. So to try to align yourself with this 50-30-20 rule is pretty hard to do. I will say 20% of the investing is I highly recommend that. I do 20% personally of our gross income. Um, Currently it's like 50% because we're trying to pay off our mortgage, so that counts as that. But as far as like investing in the stock market, I think 20% is really good in this situation. 30% for once, in my opinion, is a little high. But I'm not going to bash it. It's just everyone's preference is different. I think this is a good rule of thumb. So if you do 30% your once, I'm not going to say you're doing it wrong. I just think it's personally high. I don't know what my once would technically consider or be considered percentage wise. But I would assume it's lower than that. And then 50% is your everyday needs. So I think as a starting point, it might be good, especially if you haven't had one, to kind of aim for that. But after that, you're going to quickly find out your percentages are going to vary greatly. The only one I would stick to 100% is this 20%. I would say 15% plus to retirement at all times is a necessity. Capital One 360 and Ally are very good for sinking funds. Yep, I did. I have a Capital One 360 as well, so I think those are very good. I've heard a lot of good things about Ally. What do you recommend to track earnings in budget options trading? Budget option trading. That honestly would just come down to the same spreadsheet I provide you. I think would be fine to use. Now, options is hard because there's a lot of unrealized gains and losses in that, and it's nonstop. It's all day long. It's up and down. So to be honest, I think if you built a spreadsheet that kind of showed those fluctuations, and Chris always talks about like you're within a specific range that you're trying to hit, right? This is support and resistance kind of stuff. So maybe you game plan it off that, but to be honest, there's so much variability in that. I just don't know the best way to necessarily track it without just probably doing an Excel and maybe tracking at the end of the day or maybe the end of the week, depending on how fast in and out you are of trades. Thank you as always for the gems. Yeah, guys, I appreciate that seriously. I do this for you guys to, as much as I can share with as many people as possible. That's why I started my page. That's why I'm doing what I'm doing. That's why I'm part of Wealth Squad. I'm very passionate about helping you guys. So if you guys ever have questions on like my personal accounts or Wealth Squad, always DM me, and I'll answer as quick as I can. 15% pre-tax or post-tax income. So typically I do pre-tax. And the only reason I say this is, pre-tax is just better because you're going to do more technically. The financial industry in general is going to say pre-tax. And ultimately, when people ask this question, I say, well, do you want to pay more or less to your retirement? And if you do post-tax, it's after tax, and the 15% is going to be less. So I always say pre-tax for that reason. So if you make $15,000 or $100,000 pre-tax, let's say a combined income at the household is $100,000. Basically, your retirement would be $15,000 at that point. So you could allocate that to a Roth IRA, a 401k, HSA even, so stuff like that. My IG is Budgetdog, so I think you can see that in. It says I'm the Wealth Squad here. Yeah, Budgetdog. Budgeting is literally the first step of all of this. Yes, 100%. Because if you don't know what you guys are trying to save for or all that kind of stuff, it's really tough to game plan. So yeah, I totally agree with that comment. And I apologize. I'm having a coughing fit because I'm a little bit sick right now. All right, budget dog, that part, yeah. When paying off debt, do you recommend paying off smaller amounts first or high interest? That's a great question. This question gets brought up a lot. So there's the quick answer and the easy answer for most people is I would pay off from least to greatest dollar amount. And because that's basically the debt snowball, right? So there's the debt snowball and there's the debt avalanche. So with the debt snowball, it's the reason why it's called the debt snowball is because you're getting a momentum, right? That snowball is kind of rolling up, and with time, you're getting better and better, and you're knocking off this debt and that debt, and you're starting to feel from a behavioral perspective a lot better than you once did, right? Even though, let's say, a student loan still sits out there, you've still knocked off four debts, and overall balance might be much different, but you're gonna feel better. It's gonna like a weight is lifted off your shoulders by doing that. So I always think that you should do um, lowest amount, unless in situations where I deal with clients one-on-ones all the time. I do those often. As you saw in my link in bio, there's a book a consultation link if you guys are interested in that. And when I look at a client situation, if I see, like, let's say a credit card interest rate of like 25%, something abnormally high, right? I will almost always attack that one first, because I cannot morally, or like, I would feel sick to my stomach if I told somebody not to pay that off first, even though it's a big balance and there might be um it might be difficult to attack that one first. From a financial and number perspective, it might make sense in some situations, but for the most part, I think the behavioral aspect of finance is fascinating. I'm very into psychology as well, so when I link the two with psychology and finance, it's really fascinating what I find, and so that's why I mostly go with the behavioral side. What's your advice on paying off debt? I think personally, if you guys follow me on Instagram, I am paying off my 2.375% mortgage. And people think I'm crazy, but I have a lot of videos on why I'm doing what I'm doing. We paid off $76,000 of debt in 1 year, 3 years ago. And so for me personally, it's more an emotional thing, where we had a lot of stuff on our plate, and my wife and I were not in a good spot emotionally. So debt was a major reason of that. So I paid it off personally. Now, some people are going to play the interest rate game and say, hey, you can get 10% interest in the market versus paying off a low percent debt. I understand that argument totally, and I'm not going to knock you for it. But I will say, for me personally, I would pay off debt as fast as possible. What we did was paid off that non-mortgage debt of 76,000. Then we started investing 20% of our income, our gross income, and then we got into paying off our mortgage. So in the last 2 months, at December and January, we put down 30,000 extra on the mortgage. And we took that really serious. We're trying to pay off our mortgage this year in particular, which would be 6 years in total. We have currently, if you guys have been following the process and journey on social, it's down to 91,000. So our goal is to get that gone as fast as possible. I think living a debt-free life makes a lot more sense. I think it's, there's the biblical side of things that says the borrower is slave to the lender. Whatever your take is on that, that's whatever. But I think the general principle there stands strong, is if you're going to owe all these banks and all these people money, you're somewhat of a slave to them in some sort of fashion, because you can't really maneuver if you want to. And so we like opportunity. We don't like a bunch of fancy stuff. We don't really care for that kind of stuff. And I think paying off debt and living a free life, where we don't have to worry about that's huge. And we have one on the way. So that's a big reason I'm doing this as well, is I'm trying to stay home and with them, and that's one way we can ensure that happens. So it's kind of bigger than the numbers when I look at it, but that's just my take. What are your thoughts on paying off your mortgage? I pretty much just answered that one. Sorry, I saw that answer or that question late. But for everybody else that's trying to thinking about their mortgage, that's one debt I do not think that you have to rush. And I would never get mad at somebody that says, hey, I want a 15 or 30-year mortgage at 20 years old and just pay it off slowly throughout time and invest the rest. I think that's totally fine. But from my perspective, I'm still investing during this time when I'm paying it off pretty substantially, like I said. But for me, it's just like, hey, our mortgage is 1,015, as you saw on the expense chart. And if I'm able to pay that off, I free up $12,000 extra a year, and then I'm able to stay home with my kids eventually. So for me, that's more important than trying to delay the 30-year mortgage or whatever and pay it off within 30 years. So just my take. Would I recommend Acorns or Digit? I would not. And here's why. I think it has a good purpose and I think it means well. I think the whole thing was really cool. Ashton Kutcher, I think, is one of the investors in Acorns. I always see his YouTube on YouTube. I see his commercials. The problem with this is fees when it goes into investing are the biggest killer. My Investing 101 book talks about this is the fees will crush you and people don't understand a small fee will absolutely derail you. For example, in my book, I talk about this example of I'm trying to remember it exactly. There's $500 invested for 30 years at 7% returns. And at the end of that 30 years, you've invested $180,000. At that end of that time, if you paid a 1% fee, you're going to be paying almost $100,000 in fees. And so a lot of people say, well, 1% is nothing, right? When they go to a financial advisor, but that's what they charge you. 2% would be almost up to 200,000. It's like 180,000. And that's a small example. Some people invest more, some people invest less. So that's going to determine how much that fee actually impacts you. But with Acorns, there is a small amount going in there. It's the change that you from each transaction that you make, right? You go to the store, you spend 582. Well, the 18 cents remaining on that dollar is going to go into Acorns. Well, Acorns has a fee structure that's like $1.25 a month. And so if you have $100 in there, which is actually pretty hard to do with Acorns because it's spare change. Well, now you have a one and a quarter percentage of a fee, and that adds up over time. So I think that goes back into our budgeting conversation is if you give every single dollar a name and really go at it, then you're not going to have to worry about that spare change. You're going to know where that goes before it actually happens. And so that's why I don't recommend Acorns and Digit. But I understand if you guys have it, I'm not bashing it in that way because I think it's the intention is good behind it, but the numbers don't necessarily add up. What do you think about a separate brokerage account for various goals 3 to 5 years out? Example, a car in 3 years, a house in 5 years, or would you just keep in cash? So what I often talk about is anything for a goal, let's say a 5 year plus goal. I would always invest into a simple low cost index fund like VT Sachs, which is like the total stock market, or a S&P 500 fund. So if you want to do a basement renovation, that's kind of what we're going to do in the future. And we know it's going to be, let's say, $25,000. We can put that into a brokerage account and let it grow. The reason I say 5 years is the cutoff is because typically with the market, I think dating back to 1926 since inception, 95% of the time in any 5 year period, it's going to make money. So your probability of making money is almost guaranteed. But under that 5 years, there's really no guarantee. And so I wouldn't want somebody to put a down payment for a house into a brokerage account for, let's say, 3 years. And then that 3 years ends and all of a sudden they have to pull it and they have less money than they originally anticipated. I would just keep it in cash in that situation. So I think the 5 year mark is that cutoff. I hope that answers that question. Any advice for federal student loans? I will tell you, so from that question, I mean, that's pretty general, but I'm going to say this is do not rely on the government. I I just I don't believe anything they say. The politicians, and this isn't for me going one side or the other. I don't trust whoever's in office at all ever. What they say, I think the Biden administration mentioned the $10,000 forgiveness. I would not rely on that personally. I would just attack it myself because like let's say 3 years ago, they were talking about that 3 years ago when I was paying off my debt. If I would have waited for that time, well, I would still be sitting here with student debt, paying the minimum, and it would be 4 years past, and I would still be. Is the government going to do it? Is it not? Obviously, if they do, that's awesome. I would take it. I wouldn't say no. But I'm not going to sit there and wait for the government to do something because they don't have your best interests, whether they say they do or not. Let's be honest, they're all politicians. They're not necessarily maximizing, trying to maximize your pockets. So I would just take that to on your end and budget for it and pay it off as fast as possible. I'm sorry. So, okay. So this one, a Digit is an amazing savings app. I've been using it for a few years. Helps me without even noticing. Yep. Awesome. That's exactly what the intention behind it. I'm sorry I missed the part about behavioral finance. It sounded interesting. Could you go further into it? Finance and psychology. Yeah. So with the psychology guys and the finance is, I'm a big believer in people that want something are going to get what they want. And so when you stick your mind to it, you're going to get what you want. And I think behavior plays a huge role in that. So many people in the financial industry, I have a ton of friends that are financial advisors, and they will just say blanket advice like, hey, if you have a 6% or higher debt, pay it off before investing. If you have it below, do not. But I disagree with that. I think everyone's different. And I also think behavior plays a huge role in it. The power of intention is something I cannot explain. Like when I want something and when you want something, you're going to get it. You are. It's just a matter of getting it. And so and planning for it. So when it comes to finance and money, if I say, hey, I'm going to pay this debt off in this year, like for my mortgage, I will find a way to do it. And it might not be at the current numbers that I'm dealing with, right? You might have, um, we have $90,000 on our hands with this mortgage. And so are we able to do this? It's pretty close. I'm going to be honest. I don't know if we will technically from a numeric perspective, but my mindset has already been we will pay this off. So it doesn't matter. I will find a way. If it's to make extra money on the weekends, doing something, whatever that may be, it is a goal of mine. It is a goal of ours. So we're going to do it. And so I think behavior plays a big role in a lot of financial decisions. I study the markets a lot with the timing of the market and all that kind of stuff as well. So there's a lot of studies on this. I know there's I've actually just tweeted a really cool study. I'm trying to think of which one it was tonight. Oh, it was a men versus women one. It was really interesting. Women actually tend to do better in the market than men by 40 basis points, which is like 0.4% because of the behavior side of things. Men are more overconfident with their decision. They think they can beat the market more. And therefore women typically outperform men. So it's stuff like that. There are so many different countless studies I've read and, looked at that kind of further that conversation. So pretty interesting. Where are some free portfolios? I have Stash and they charge $9 a month. Free portfolios, I would just go with uh let's a Vanguard, a Charles Schwab, a Fidelity, and just open like a Roth IRA or a taxable brokerage account. Yeah, $9 is a lot. And that was my point earlier with the fees is if you have $9 and you have even $1,000, right? That's still a pretty hefty penalty, right? 0.9%. And if you have 100, that's huge. That's a large percentage. Um, most of my clients I've dealt with when I've looked at their, portfolios and they have fees of like 2% tops, which is still a lot. I've never seen anything crazy like 9%. So that's scary. I would definitely get out of that and probably just go to like a Vanguard, like I said. Do you recommend negotiating debt with credit card company if interest rates are overwhelming, like a workout agreement or lump sum settlement? Um, it's going to take a hit on your credit if you do that. I think budgeting and having that all set up, I think is going to give you a better picture than emotionally reacting. So I often talk to my clients about this as well, is like if somebody doesn't have a budget and they're really tight on money and let's say something happens with their car, they're more likely to overreact in that situation and go buy a brand new car, furthering their money issue rather than thinking, hey, maybe maybe a new transmission might be $2,000 and I could actually just do that for the next couple of years rather than spending 20,000 in a new car and going in debt for it. And like, so same thing when it comes to negotiating credit cards. If you just get in this situation and do not react with an emotional standpoint. It's hard. We're all human. We all have emotion. It's natural, right? So trying to fight against that's a battle in itself. But if you put the pen to paper and really understand exactly where your money's going and seeing if, hey, maybe I have a plan myself to pay this off, and if you do, go ahead, go for it. Think of other ways to make money. I think when it comes down to it, like I said earlier, if you want to achieve it, I think you can. And I wouldn't put it in a debt consolidation program either. A lot of times those companies will make a lot of money off you in the meantime. And from a moral perspective, I don't know. Kind of makes me feel a little queasy that they're helping you pay off debt per se, but then they're taking money from you at the same time. It just seems a little weird. Um, and those debt collection agencies are, there's some dogs. They're going to come at you and they will call you until you go crazy. So I'd be very, very careful with dealing with those kind of people. Example on the Acorns, dividends last month were 157. Subscription fee was $1.57 is the total gain. Yep. Do you recommend getting a loan to pay credit debt? I do not. So same thing is like in this situation, it's kind of interesting. So it depends. I'd have to look at the numbers exactly, but typically I would not, because I think if you're going to go get debt to pay off a debt, it's going to be an ever-ending cycle, and you're not going to end it right then and there. I would recommend as simple as it sounds, get on a budget and figure out exactly what you got to pay and pay it back and make it happen. Because if not, I feel like it's going to be an ever-ending cycle that's just, oh well, it's okay this time type of mentality, and that's going to go a long way with going forward and stuff. So I think that's all the questions I'm seeing, guys. I have some more time. I have plenty of time to answer whatever you guys want. So as things come in, I'll keep answering. If you come across a large sum of money, for example, an inheritance, that's awesome. Hopefully, would you recommend putting it all in an IRA or similar account? So I typically look at this as like, what's my current goal? What am I currently trying to achieve? So if I'm in a debt payoff cycle, I'd probably put it to debt. If I was trying to save for an emergency fund, I would put it to that. And then lastly, if I was trying to invest, for sure, put it in an IRA. You could put it in a taxable brokerage account. You could put it in a 529 for your kids for college. There is a UPMA, an UGMA, Uniform Gift to Minors Act, for your kids as well option. And so there's a bunch of different options for your kids. There's actually a Roth IRA option for your kids. A little hack for you parents out there. If you guys have kids and they are earning some sort of income of any, it doesn't matter if they're shoveling driveways, cutting grass, whatever. If they make money, you can invest in a Roth IRA in their name up to the amount that they file with the IRS. And so that's a great tool for your kids going forward. If they make $5,000 in the summer, that might not be a lot for you, but for them to put $5,000 in a Roth IRA is extremely powerful at, let's say, 12 years old. That's insane what that could become. So yeah, I would focus on whatever goal you're currently focusing on and just go down the steps for the inheritance. I think I missed your federal student loan answer. Could you please repeat? Yes. Okay. So when it comes to the loans with the student loans, the biggest thing, guys, is just it's your responsibility to pay it off, and I think it ends with that and begins with that. I think if you try to pull from a government, I don't think taking that, if they give you that $10,000 that they're talking about right now, take it. Obviously, right? I would never not take that, but I would not wait on it. I would not create a plan that says, hey, it's kind of like Social Security. Think about this. My retirement is not relying on Social Security like at all. I don't even know what I'd be technically able to get for Social Security. It's so far away. And honestly, at my age, like they've been saying that we might not get it, right? And so same thing goes for student loans, is like in another example would be a 401k match. Like they're all benefits, they're all cherries on top, but I would not create a plan around that. I would just go ahead and attack your student loan. And if the government decides to give it to you, hey, let's deduct an extra 10,000 or whatever they end up deciding on, and then approach it that way. What are the main steps to approaching to getting rid of debt in terms of percentage of your recommended budgeting? Yeah, this is a good question because this is something I personally experienced. So when it comes to a budget, one other thing I think you should get is a balance sheet. And for those that don't understand what a balance sheet is, it's simply your assets minus your liabilities give you your net worth. So your liabilities are going to be all your debts listed from greatest to least or whatever, based on amount. And then you're going to have your assets like your house, the value of your house if you sold, and then the value of your house, the mortgage, outstanding mortgage would be in your liabilities. The difference would be your equity. So to see that snapshot's really, really, really important. I talk about this a lot. Whenever somebody signs up with my one-on-one clients, I give them a balance sheet to fill out and a budget to fill out because those two pieces are huge. So what you do, you take your budget, you see what's left over. Assuming they've never budgeted before, they'll have some. They won't do the zero-based budgeting, and they'll have, let's say, $500 left over. You would take that $500 and basically move it to each month as your shovel to pay off whatever debt that you have. And then when you have that budget, you can go through the expense items and think, hey, we have X amount going to subscriptions to Spotify Premium, um, Apple, Hulu, all those kind of Netflix, all that kind of thing, all those things that you don't technically need. And when you're trying to get out of debt and on a serious budget, the last thing you need is Spotify Premium. It's a pretty cool gig. I'm not gonna lie. I've had it before. You can select your song, but you can hit YouTube up if you really need, right? On your phone, and you can also hit next. Like you're gonna have 5 skips an hour, whatever. Do you really need the extra $15 a month? Stuff like that can be cut really quickly from the budget. Um, Saying no is a huge piece of this, and so this is something people don't look at because it's not a monetary thing. If your friends and family want to go on a vacation, if they want to go out for the weekend, say, hey, let's go to the bar this weekend. Obviously, COVID's a little different, but like, let's go here and there. Well, if you say no, you're going to spend a lot less money than they would and what you would have. And there's a huge power in that. I learned to say no a lot. And my family wanted to recently go down to Florida during Christmas for vacation. I said, no, I have these goals. It's nothing personal. I love you guys, but like, I have to, achieve X, Y, and Z right now. And that was not in the plan. It was a last minute thing. You guys just sprung upon me. If you guys plan it out, that's different and stuff like that. So think of saying no. It's really important. And that's how I got through paying off that $76,000 of debt in 1 year. I realize in the stock market, more money makes more money. Yep. Should I use some of my gains and pay off my debt or my fixed income? Typically, I keep investing and paying off debt separate. So when I make money on my gains in the market, it's either retirement or non-retirement. But if I pull that money, I'm going to get taxed at some specific percentage. So with retirement, you can't do that because you're going to get taxed a 10% penalty plus ordinary income tax rate. So there would make no sense to pull, let's say you're in the 25% tax bracket plus an extra 10. You're basically saying, hey, I'm going to pull that money for 35% to pay off a debt that's 10%. And so numerically, it doesn't make sense. And so I would not do that. Same thing for capital gains. So in a non-retirement account, you'll get tax capital gains rate. And so it could be either short-term or long-term. Short-term is going to be a ordinary income tax rate. So if you pay it off within, or if you sell out from a stock within 1 year, you're going to get taxed at your ordinary income tax rate. If you hold, you're incentivized by the government to do so more than 1 year, then you're going to pay the long-term capital gains rate, which is still 15%. So most likely it doesn't make sense to pull a 15%, investment that's compounding and making a lot of money to pay off your debt. And so that's why I like to look at those separately. And that's how I would approach that. Do you recommend different bank accounts for different goals, activities, emergency funds, savings, bills? It depends like how many you have. Like if you have a bunch of sinking funds, so what we do I'm going to tell you what I do personally. So we have my business bank account separate from my checking, obviously, but we have one checking account and we have an emergency fund in a Vanguard taxable account. That's a money market fund. So that just sits there. Everything else goes out of our checking account. If we have a savings goal, like a sinking fund goal, we put that in our savings account within our bank. And so all of we just basically do the math on a spreadsheet. So if we have, let's say 2 or 3, we would say, okay, 200 for this one, 300 for this one, and 200 for this one. Well, we're going to have $700 a month going to this savings account. And that's kind of how we would do it there. What percentage do you recommend going towards one emergency fund each month? I typically look at not a percentage there. I look at setting it and forgetting it. So I think that's a really important step to just, hey, pay off your debt, and then go straight to your emergency fund and really fund that fully, and then never do it again. Just set it. Let's say that amounts $10,000. Put $10,000 in there, and then just never touch it. Keep it in the emergency fund. So as far as getting there, I think whatever your current goal is, let's say it's paying debt, focus all the extra income to debt. Then you get to the emergency fund. Focus all the extra income to the emergency fund versus saying, hey, this is a percent that should go there each month while I'm doing X, Y, Z, ABC, and all these things, because that gets really complicated. All right, I looks like there's a lot more messages that are coming through here. I'm going to answer probably 5 more. We've hit our hour mark. That's totally fine. I'll definitely go over for you guys, but I can't go forever. So I'm going to answer 5 more questions. Let's see. Is there a way to consolidate credit card and mortgage payments? There might be, and I don't know, to be honest. I know you could take a HELOC out on a house. I'm not saying this is a recommendation by any means, or advice. I would not do this. I would keep the two separate to be for starters there. But if you were to get a HELOC, which is a home equity line of credit, you could technically take a mortgage out on your house and then maybe refinance into that, or take a personal loan out of a bank and refinance for a lower rate. But that's about the best answer there. I'm not really sure exactly. I've never thought about that. Good question though. If not 401k, what are the best ways to invest, plan for retirement? The other way would be IRA. I've talked about the IRA is the best, I think, individual retirement account. $6,000 for the for per year for any individual. So that's by the government mandates that number, and that would be the other best account. An account that no one talks about for retirement that I think is an excellent way to save, and the financial industry is finally picking up on this after years, is the HSA. So the health savings account is a really, really good way to save for retirement, because I think it's the average person has like $300,000 in medical expenses after 65. So to save for that's really important, because health savings is obviously for that. This is a hack that I think a lot of people don't understand. So it has the triple tax savings. So you put money into the account tax free, the money grows tax free, and then you can pull that money tax free eventually. What's really cool about the HSA is if you spend out of pocket for your medical expenses along the way, you can actually save those receipts. And then at a later date, you can pull that money tax free for whatever. So that's what I do personally. We pay all medical expenses. My wife's going through all of her doctor visits right now, and every time she goes there, if the copay isn't covered by the insurance, we just go ahead and pay it out of pocket, save the receipt, and now we can take that money at a later date for tax free because it was in the HSA. So that's a really cool thing, and I actually have a link to First Dollar, which is an excellent HSA option. It has great investment options. It's the best one out there. So if you guys are interested, just DM me after this and I can get you that link. But HSA is a really good option for retirement. And also taxable brokerage, guys. A taxable account that everyone trades through, or invests through, is a really good option for when it comes to retirement as an early retirement option, because you can't touch your money with retirement accounts till 59 and a half. So if you're like, hey, I want to retire early, the taxable brokerage is probably the hack. Like Chris, he shows his taxable account is like crazy amounts, right? Dude's insane. Like 3.5 million. But he basically can technically tap into that whenever before 59 and a half. So that's an awesome way to refinance as well, or retire early as well. Besides making a budget, what other tools or resources did you use to pay off your $76,000 in a year? Yeah. So like I mentioned earlier, a balance sheet's really important. That was one of the biggest tools, so I could see the financial snapshot of where we were, and then a budget. And then lastly, a mortgage payoff or a debt payoff calculator. I actually have that in my store, my Gumroad store. It's like $5. That was a huge tool because you could actually map it out in paper. So what that is essentially is I have a built-in amortization schedule for you guys, that if you guys just put in like interest rate amount and extra money that you pay towards each debt, it's going to map out automatically for you exactly how long that's going to take. So if you put in, let's say, an extra $100, well, you're going to be able to show, like on the spreadsheet, it's going to update automatically for you and say, hey, this is going to save me an extra 2 months. Then you put like $200 extra in it, and it's going to update automatically for you through all these calculations that I've already built in for you. You just have to put in like basically your inputs. So that was a huge piece of it. So it was the balance sheet, the budget, and the debt payoff calculators. So I have a mortgage one for you in there and a personal calculator in there. And if you have multiple debts, you can just copy and paste the tabs over as many as you need. But those are the 3 tools I used. Lastly, I'm going to say my wife. No, I'm just playing. She was actually really helpful during the process. Being on board with your spouse, guys, underrated. That's huge. Would you recommend putting your emergency fund in a money market account or just regular savings account? I think either one's fine. Like I said, mine's in a money market fund through Vanguard, a taxable brokerage account. So I think that's an awesome way to do it. Regular savings account. I'd probably go high yield savings account versus regular. Not that a high yield is going to do much with that. The emergency fund probably is not going to have too much money in it. And let's say you get, I think currently they're going at 0.6%, which are pretty crap. But even if they got up to 2%, it's not going to make or break you, but it's going to be better than like 0.0008% through PNC Bank. So, can self-employed have an HSA? The only requirement for yes, and the only requirement for an HSA would be for a high deductible health plan. So as long as you have a high deductible health plan, and it doesn't make sense for everyone to do that, then you can have an HSA. But that's the sole requirement for the HSA. So I think I got through all the questions, guys. So I appreciate everyone that showed up tonight. Use me as a resource, guys. I love being in Wealth Squad. I love helping you guys. It's a really good experience to be in and meet with you guys and stuff. And if anybody has questions, you guys can DM me there. Also, all my socials, feel free to DM me whenever. But other than that, everybody have a good night. I appreciate your guys' time and enjoy.